When Pamela Sandy bought her new Ford Taurus, she was thrilled.
And it's got that new car smell.
But like most consumers, she had no reason to care how her bank got the money to give her that loan.
This market is currently in distress.
Now, however, it is time to care. For years, up to 40% of all auto loans, all credit card purchases, even student loans, have been bundled by banks and finance companies the same way they bundled risky mortgages and then sold them to investors as securities. That's the problem. All those buyers, the same global investors and pension funds that got burned by securities based on mortgages, don't want anything to do right now with securities based on consumer loans.
Investors are suspicious of securitized products, so they're no longer willing to buy those products.
Since investors stopped buying, the market for consumer credit has collapsed by 80% and shocked the American credit system. $638 billion from investors that was available last year isn't even in the pipeline this year and is not being used for new loans. That leaves the big finance companies like GMAC struggling for cash, with GM now running ads
and hundreds of lenders to help get you behind the wheel,
sending customers to banks which might have cash.
Their business model, make the loan, get it out the door to the investor, make new loans, doesn't work anymore.
And that's what's frozen.
And that's what's frozen.
To get the credit markets unfrozen, Treasury Secretary Henry Paulson wants to use the remaining bailout funds, up to $50 billion, to buy or prop up consumer credit. The lack of funds, he argues, is harming growth.
This is creating a heavy burden on the American people and reducing the number of jobs in our economy.
So with finance companies withering and investment capital drying up, banks once again are where the money is, including that $159 billion they got from taxpayers. So are banks making more loans now?
Well, I'd say that they are.
The banking industry insists it is loaning money, but that the days of easy money or nonstop credit card offers are over.
And it's 5.99%.
Just like car buyer Pamela Sandy, a good credit score gets you a loan, but a poor credit score gets you a higher interest rate.
For the consumer, it's a much tighter market out there today. The credit standards have tightened, and you've seen a retrenchment as the non-bank players have left the marketplace.
And now, with even more bankruptcies and more delinquent loans of all kinds, the declining credit picture for millions of Americans is an obstacle for Treasury's new strategy. As one economist put it, even if Secretary Paulson can fix the credit markets, he can't fix the credit scores of all those borrowers. Wyatt Andrews, CBS News, Washington.